Hi everyone, this is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like having him on every couple months to talk about oil and the energy markets. He's definitely an energy expert. He is the managing editor and director of analysis at the Energy Trends Insider, and he also writes for the Wall Street Journal and other paid newsletters about the oil industry, and he's worked in the oil industry for a number of decades. Thank you for joining us again, Robert Rapier.
Thanks for having me again, Jason.
Now, Robert, last time you were on, you dissected the BP Statistical Review, which is one of the largest in-depth studies of the oil market and the energy markets in general for supply and demand, and I think we covered supply and demand pretty good. But we've seen, just a dramatic fall in the oil price since June. I think it's dropped about 40%. Do you think the supply-demand picture has changed in oil, and or do you think that's the main reason why the oil prices dropped then?
Well, I mean, these things tend to overshoot. When there's a perception of not enough supply, the price overshoots to the high side. When there's a perception of too much supply, it'll overshoot to the downside. And the biggest thing that's happened since we last spoke was the OPEC meeting where they decided not to cut production. Now, a lot of people, myself included, don't think they'll be able to sustain that through next year. I think some pressure from members like Venezuela, Nigeria, Iran is going to come to bear on Saudi Arabia, and they're ultimately going to decide they have got to cut some production to try to shore up these oil prices, which they've done in the past. If you go back to 2008, which is the last time we saw such a deep dive in oil prices, before that happened, oil prices had run up in the beginning of the year from 100 almost to 150. And I thought they overshot to the high side on the perception of not enough supply. And then in the other direction, they ran all the way down to the 30s, and I thought they overshot down to the low side. And I think we're approaching, if not there, we're approaching overshooting down to the low side on the perception that there's plenty of oil. But there's not plenty of $60 oil. So if oil hangs around at $60, we're going to see enough cuts in capital budgets that it will ultimately affect supply, and we'll end up running the price back up even without OPEC doing anything.
Yeah, those are good points. From what I saw, I think OPEC just put out a statement in the last week or so, and they said that demand had only dropped, I think, by like 280,000 barrels a day or something like that of oil, and that there was a little too much supply. But I guess the market's perception is that there's a lot more supply right now. But I still think, over the long term, there's a lot more fundamental arguments for there's going to be more demand than supply, especially at $40 barrel oil or $60 barrel oil, because, over the last 10 years, 12 years, there's just been a constant pressure, it seems like, Robert, for capital expenditure, for production costs rising. It just, even with these shale plays and some other technological innovations, it doesn't seem where there's many oil plays where the production costs have rapidly fallen.
Yeah, that's correct. I mean, one where they have is in the Eagle Ford in Texas. Break-even costs for a lot of producers down there are $40 a barrel or so, but the marginal barrel, which in the Bakken or the Permian Basin, is probably in the $75 to $90 range. And you're already seeing announcements that capital budgets are going to be cut. That won't affect production a whole lot next year, but a couple of years down the road, you'll see those supplies that would have been online with oil at $100 will not come online. And so we'll see some erosion in capacity growth, and at the same time, those low oil prices will spur demand and heat up the economy.
Yeah, well, except that, like, most of the jobs created, Robert, in the United States, most of the high-paying full-time jobs that have been created have all been out of the oil industry, or, the multiplier from an oil job either in Bakken in North Dakota or in Texas in the new shale place. So it'll be interesting to see. Yes, the lower oil price is stimulative to the economy. It will put some discretionary spending back in the consumer's pockets, but almost all the jobs that were, like I said, the full-time jobs were all oil jobs. So it's an interesting balance here. We'll see how the market reacts in the future. That's a great point you brought up, though. The figures that I've been seeing about the capex, I think the capex budget was supposed to be over $700 billion globally spent this year for oil and oil budgets, right, for increasing production or just sustaining it. And I think now the projected cuts to that over $700 billion in spending is $150 billion in capex drop after this drop in oil price.
Yeah, there have been announcements coming every day. ConocoPhillips, I think, announced last week they were cutting capital spending. I think the small producer in the Bakken, Oasis, announced yesterday, I believe they were cutting capital spending in half. And they said they'll still grow production. They will still be cash flow positive next year, but this will affect them a couple or 3 years down the road.
Yeah, and I mean this is how markets are supposed to work, right? So when the solution to high prices is high prices, right? When the oil price went to $140 a barrel, it basically froze the economy. The U.S. consumer couldn't afford $4.50, $5 a gallon gasoline routinely because their incomes weren't rising. It was hurting their discretionary spending budget. The demand, the marginal consumer, where the marginal demand for oil is, that slowed down, so that helped curb the prices, and the cure for low prices is low prices. So when the oil price gets too low, when it gets below the cost of production, especially for that marginal producer of oil, they're going to cut back on their budget. They're either going to slow down their production or stop producing entirely, and that's going to eventually put a bottom in the market.
That's true. That's been the case with the oil industry as far back as the beginning of the oil industry. Good times, everybody's in there spending a lot of money, and then they overproduce and sink the price, and then they cut back on their spending. So the cycle continues. I think there'll come a time when the cycle won't be able to continue because supply just simply will not be able to keep up with demand. But as long as supply is able to race ahead of demand, we'll continue to see these cycles.
Yeah, and you also wrote a piece that I read in the last couple weeks, I think, and it was talking about where the majority of world's production growth is coming from, and I think that was a great point in your article. You said that I think almost 85% of all the world's oil production growth since I think 2006 has come from the U.S. shale oil plays. Is that correct?
That's correct. I think I looked at the past 5 years. In the past 5 years, of the total global production increase, the U.S. is responsible for 85% of that.
That's amazing innovation. I read the book, The Frackers, which is a great book, talking about Harold Hamm and from Continental Resources and the stuff he did, and then also I think the Mitchells, they're down in the Eagle Ford. But, I think it says bad stuff about the rest of the world, how, the national oil companies and these other large oil projects and stuff all over the world, they're struggling to grow production. So, yes, there is shale plays, I guess, in Argentina, in Australia, in China, in Poland, but the U.S. seems to have enormous advantages to why they were able to get the shale plays online faster, and, there's better infrastructure here, there's more easy access to water, and the costs were just so much lower compared to the rest of the world, because we've seen what the failures of ExxonMobil going into Poland and other countries trying to do shale plays in other countries at a lower production cost.
I mean, that's true. We've got the right geology. We had the right oil price for people to get out and innovate. George Mitchell going out and doing the horizontal drilling and combining that with the hydraulic fracturing for the first time. All those innovations and all the infrastructure we had in place allowed that fracking revolution to happen here, where the geology of some countries is more difficult. The Monterey in California is a good example. There's a shale play where the geology is very you can't horizontal drill that because the formation goes up and down, and so that, even though there's a lot of oil there, you can't get it out with the way technology is unless you could horizontally drill and just have the drill go up and down and follow the formation. And a lot of places in the world are like that, where they don't have exactly the right geology. And then, as you said, I mean, fracking still requires a lot of water. There's a lot of work being done to try to figure out how to frack without water, and some success, but really water is still the cheap option there for fracking. And some of the places in China where there's a lot of shale oil and gas, they just don't have the water for it.
Yeah, gas frac I think was trying to do fracking with like liquid natural gas or something like that, and they were getting some traction with some smaller companies, but the larger players haven't adopted the technology yet. I know Chevron was testing it. They said it in their annual report a couple of years ago, but that company stock has cratered because, like you said, people haven't adopted to the new fracking technology there of switching to non-water. It seems water is the way to go, although, there's companies out there like Origin Oil and others that are working on ways to clean up the water or recycle the water for fracking, so it's easier to use, but it does use in a humongous amount of water, which has pissed off the environmentalists. My question for you, though, is do you think there was a lot of political pressure involved in the drop of oil prices here? Do you think the Saudis then were pressured by the U.S. government or Wall Street to put pressure on the Russians or hurt the Russian ruble or Putin economically then?
I've seen no evidence of that the U.S. put any pressure on Saudi, but Saudi may have decided themselves, they can withstand $60 oil for a long time, and it does hurt Russia, it does hurt Iran, and Saudi and Iran don't have the best relationship. So, there may be some political aspects there, but I think more than anything, Saudi is just seeing that as long as this shale revolution continues and we get further and further up the learning curve, costs go down, it puts them in a difficult position. So if they can try to cut this off now at the knees, I think that's what they're looking at. They're looking at if ultimately they'd like to set prices like they've done for so long, and they've lost a lot of that pricing power. And I think that is the reason that they didn't cut production. They're saying, you want to have a price war, we can have a price war. We've got a lot of oil, and we can outweigh you. But in the long run, I think they're thinking this will be good for us. We'll gain back our market share, and then we can dictate prices once again.
Yeah, so you think then this drop in oil prices, it seems to me, Robert, that this is only a temporary drop, so maybe a year, maybe 2 years, maybe 3 years at most. And if you go back through the historical prices of oil, it seems, every time there's been a new major oil field, like whether it was the North Sea or whether it was the oil in Alaska coming on in the late 70s or 80s, or the first instances of offshore oil drilling in the U.S., every time a new supply came online, the Saudis didn't like it. The oil price was going up, and that's why the new supply came online. And then the Saudis, OPEC came out with a new strategy, and they took the price down violently, and they drastically slowed down the production and growth of that new oil field. And it seems that, history is repeating itself, I guess, in the shale play.
Yeah, I mean, I try to look at it from Saudi Arabia's perspective to understand what I think they're going to do. And so if I'm sitting there as the oil minister of Saudi Arabia and I'm seeing this, and I know the kind of government that we have in place, so we can largely do what we want. We don't have to get congressional approval and so forth. We don't have to worry as much about popularity as we do in a democracy. And I think, what would I do? If I'm working in Saudi's best interest, that may be what I do. It all depends on their perception of how much shale oil can grow. I mean, if they're looking out 3, 4, 5 years and they believe that shale oil production is going to peak and start to decline, then I probably would have gone ahead and cut production and propped up oil prices, because it's just a matter of time before the new supply start to decline. But I think they're worried that this could go on for some time, and they need to try to get on top of it right now.
Yeah, I think based on the technological innovations, we've seen like these octopus drilling pads, and we've seen new fracking techniques. I think the stacking, and they've come up with new ways to use sand. I think the amount of sand used in each frack job now is more than doubled. I read Dan Steffen's newsletter over at the Energy Prospectus Group down in Houston. It seems they're coming up with new technological innovations. They are getting more yield out of the oil. I don't know how much costs have dropped in every single shale play, but it's amazing what's been done in the U.S. I'm not sure it can be done all over the globe, though, in every other country for other reasons I've outlined. Maybe it can be done in Mexico easier because it's right across the border there from the Eagle Ford, but I think these shale plays in some of these other countries, the production costs are going to be too high. There's no infrastructure there. Like I said, there's a big water problem moving the water back and forth, and the governments of those countries might not agree to using that much water and trucking it that far. The costs are going to be prohibitive, at least for now, unless the oil oil price, goes to $130 a barrel or higher and stays there, I think, for these other shale plays outside the U.S.
Yeah, I mean, Argentina is a very promising location from a geological perspective, but from a government perspective, you never know. I stopped betting on South American oil companies a long time ago. I owned Petrobras when the bottom fell out of the oil prices in 2008. I bought Petrobras, and my share price tripled in less than a year. And because I said no way can oil sustain $30 a barrel, and so Petrobras was my choice, and it was a good choice at the time. It was a good choice for the next year. But then I held on to it, and over time the government just eroded the value of that investment, and it's burned me from investing in South American oil producers. So I look at Argentina and I think if they could get their government finances in order and kind of ease investors' minds, and they could very well be the place for the next fracking revolution.
Yeah, Argentina has great geology, too, for metals. I mean, they have a humongous amount of silver and copper and gold there, too. It's just a really resource-rich country. They have great land you can get grass-fed beef. There's amazing Argentinian steakhouses. I'm friends with Doug Casey, so he talks about how amazing, the food is down there, and it's not super expensive. You can get grass-fed beef at steakhouses and things like that. But, their government won't get out of the way. Petrobras, they've loaded the balance sheet with enormous amounts of debt. It seems the government's, been playing games there so they get the government gets the tax revenues from the oil, and then they load Petrobras with debt, and they've been playing games, with the capex and other stuff. I think there's some good private sector oil companies down there. Pacific Rubiales is good. They're all over Latin America. You should take a look there. But in terms of the production costs for shale oil producers in the U.S., we've seen a lot of debt. A lot of these shale, one of the main things about the oil industry, it's a main axiom of the oil industry is you don't drill with debt. But we've seen a lot of shale oil producers, I guess they know the oil's there and they haven't hit dry holes, but they've been using an enormous amount of cheap debt to grow. And now that the oil prices drop back down, do you think we're going to see a lot of bankruptcies in the Bakken and in the Eagle Ford coming in the next 6 to 12 months if the oil price doesn't start going back up?
Probably in the ones that are loaded up the most with debt, but even in some that Oasis has a fair amount of debt, but I've watched them very closely, and if you believe what they're saying, they believe they'll still be cash flow positive and they will actually grow production next year. I'd feel more comfortable with a position in the Eagle Ford, I think, with a producer there, because I think they can sustain lower prices. I think EOG Resources will be one of the last players standing if oil prices went very low and stayed there. But they'll probably scoop up some of these other guys. I mean, some of the bigger players that have cheaper costs, I think they'll end up scooping up some of the Oasis Petroleums and Raxus and so forth. They'll be looking at those guys and saying, I think they're too cheap, and they'll buy them out. A few of them, I think.
Yeah, we saw that with Kodiak Oil and Gas. They were growing with an enormous amount of debt on the balance sheet. I bought Kodiak, I think, in 2009 at $2 a share, and I sold it at $6. Because I was looking at the balance sheet at the time, the oil prices had already started going back up, and I was just worried how much debt they had in their balance sheet and how much debt they were using to grow. Obviously, the stock went to 12, but now Whiting Petroleum bought it out. I think that was a smart long-term move, maybe by Whiting to buy them out, and smart for Kodiak management to clear the balance sheet, basically, because a small company using that much debt is a very dangerous sign here when the oil price drops.
Yeah, I mean, when it's going up, it's great. I mean, you can get incredible returns. And, a company like Oasis that's had the market cap shaved so drastically, if oil prices go back up above $70, Oasis will double or more in pretty short order. But if they hang around where they're at right now, Oasis is a very dangerous investment. So, you've got a lot of risk in the market right now, and a lot of people trying to guess the bottom. And where the bottom should be is a little bit higher than where it is now. But like I said, these things tend to overshoot. The oil prices should have never dropped into the 30s. That was not justified by fundamentals in 2008. And so they bounced back up, and they were back to $100 within a year. I don't believe we're going to get down to $50. If we do, I'm going to go all in. I think there's a lot of producers that we'll still be fine at 50, and there's a lot of upside from that point. I think the upside right now outweighs the downside, but there is still a lot of downside risk. So I would caution people to know your risk tolerance and know how aggressive you are as an investor, because I wouldn't invest in something like a small cap with debt if you're a fairly conservative investor and you can't afford to lose, a lot of that investment. But on the upside, there's a lot of upside there if oil prices start to go back up.
Yeah, I mean, it's very difficult to guess the exact bottom, whether you're an expert and you've studied the oil market for a long time. You look at that hedge fund manager, I think the guy from Philbro, he's an expert oil trader, and he kept doubling down the lower the oil price went, right? And I think now he just got fired after losing hundreds of millions of dollars. So, I mean, it's very dangerous to try to pick the exact bottom and go all in for investors out there. What I've been doing actually with my own money, I told you this before in emails, is I just bought some Linco. I had never bought shares of that before, but they're hedged 5 years out at a much higher oil price, and I think it's a really good yield play. It's 22% yield right now on Linco. Maybe they do cut the distribution a little bit, maybe just for a little extra room, or maybe they do an acquisition and buy out another oil-producing MLP that's hedged. But I think it's a very interesting income play. And there's a lot of profitable oil companies. There's ExxonMobil that's had a nice drop in prices. There's just value across the board in the oil patch right now. I am really excited. As a value investor, someone who likes buying when Wall Street is selling, who likes buying when there's panic on the street. I was a little early on Seadrill. I thought the oil price had bottomed maybe a couple weeks ago. Listening to Harold Hamm talk about it and sell his hedges on Continental Resources. But I think long term there's a lot of opportunity in oil, whether that's in the commodity-producing MLPs or some of these larger shale play producers, like you mentioned, like EOG, or even some of the deep water guys, because I don't think there's going to be any way for the world to grow global oil production without deep water and other ways of oil sands and things like that. I just don't see shale being immensely rapidly growing all over the globe. I think it's going to be mostly a U.S. thing, at least for the next 5 to 10 years.
Yeah, I agree. And as far as companies go that are going to continue to be profitable, my former employer, ConocoPhillips, that's the largest holding in my own portfolio, and they are very well positioned. I think they'll continue to do well. I wouldn't recommend them for several years because they made an acquisition at a very high natural gas price of Burlington Resources, and they way overpaid for that. And so they underperformed for several years, but then when they spun off Phillips 66, which is also a portfolio holding, and the refiners in this carnage have done fairly well. There are a lot of refiners that are actually in positive territory because they can expand their margins as oil prices fall. But I've got ConocoPhillips, I've got Devon Energy. I think they're gonna keep doing well. They've been shifting more and more gas production over into oil production. There is a lot of value here. I got pretty close to the bottom in 2008. When it got into the 30s, I remember looking at myself in the mirror and saying, "Do you honestly believe that this can sustain itself for very long?" I said, "No, it can't." I don't know if we're at the bottom yet. It's just these things tend to overshoot. I'm betting we don't get to 50. But like you said, you keep doubling down your bets, and I didn't think it would go below 50 in 2008, but I didn't go all in until it got in the 30s, and I said that's low enough, and that's about as low as it went. I got it pretty close. I got it in December 2008, which was about the bottom.
Yeah, I mean, the thing about value investing, Robert, and you're a value investor too, from speaking with you and working with you a little bit at Investing Daily, is that it's very tough picking the exact bottom, and, as value investors, we can be a little early. So what I try to do is I try to not buy all my position at once, so I add a little bit to positions here. So if Lin Energy or Linco drops quite a bit more, I'll add some more. And I'll just be happy with the yield. I'm not really focused on capital gains. I'm just looking for more quality income coming into my portfolio. And Lin has been a quality distribution or dividend paying company for a very, very long time. They haven't suspended the dividend unlike some other companies out there. So what's your opinion then, Robert, on let's transition here for the remaining part of the interview. Talk a lot about oil. Let's talk about natural gas then. it seems that for supply-demand fundamentals for natural gas, the U.S. has storage problems. Yes, there's a lot of supply out there, but maybe if the oil price doesn't go back up, some of that natural gas byproduct that has grown will cut back. Do you think natural gas is also a pretty good investment right now, or not yet?
I bet earlier in the year that natural gas prices would be higher than they were the previous year, and that was correct because we went into the end of winter at such a deficit on our storage. I felt like there's a higher than average chance that natural gas prices end up spiking up. Now, they didn't spike up as much as they could have because we had an unusually mild summer. And utilities didn't use as much natural gas for air conditioning and so forth. And so we refilled inventories over the summer at the fastest rate we ever have. And natural gas producers made money doing it. And that was my thesis was, natural gas producers are going to have to produce all out, and they're going to get better prices for the gas than they did a year ago. Therefore, profits will be up. Therefore, share prices will be up. Everything was correct except for the last part. I mean, like Cabot Oil and Gas, for instance, record profits, record production, and the share price has languished. That's another one that I think is a bargain. Now going forward, we're not terribly below normal inventory levels right now. In fact, I'm looking at the natural gas storage report released today. We're 9.5% below the 5-year average. So that's not terrible shape. It's lower than normal. If we have a winter like last winter, we will end the winter at very high natural gas prices. But if we have a mild winter or a normal winter, natural gas storage will return to normal by the end of winter. And so you do have some downside risk. I predicted last year, every year I make 5 predictions in January, and it looks like I'll be right on all 5 of them this year. And one of them was natural gas price would average higher, oil price would average lower, and this next year I'm probably predicting natural gas prices are going to be lower because 2 of the 3 scenarios for winter have natural gas prices falling in the short term. In the long term, I still believe they're a lot higher because LNG export terminals are going to start coming online. End of 2015, early 2016, first ones will come online, and then there'll be a series after that. And I think investors will start to bid up natural gas prices as that happens. For Cabot Oil and Gas, the Constitution Pipeline was just approved. That's going to help them get a little bit better margins. The differentials they've been getting relative to like NYMEX gas has been quite large, and that'll help that. So that's a positive development for them long term. But in the short term, I wouldn't make a bet that we get higher natural gas prices just because it's so dependent on the winter right now.
Yeah, it seems for the LNG export facility that's going to be the major tailwinds for a higher natural gas price. So the U.S. is going to take all this either cheap natural gas in the U.S. We're going to move it on a pipeline. We're going to move it to Cheniere, first to Cheniere Energy's their export facility. I forget the name of it. Yeah. And that's supposed to be the first one online, I think, late 2015, early 2016. There'll probably be some delays, but we have a number of other places that have been permitted. Normally, that gas would go to Asia, but now that the Russians have done enormous amounts of natural gas deals with the Chinese, I think the last one a couple weeks ago was announced for over $1 trillion for like a 20 or 30-year contract. Before that, it was a couple $100 billion natural gas deal. That was a lot of the European supply that was supposed to go to Western Europe and things like that for natural gas. So I guess some of that LNG market is going to go on long-term contracts to Europe then, whereas, the Russia was putting it there before. It's just really interesting, though, because I guess there could be delays. There could be, construction overruns, cost overruns at these LNG export terminals. These things are massive, right? And they've never been built to this scale before. Actually, I don't think the U.S. has ever built any of these things before, right? Well,
ConocoPhillips has exported a little bit from Alaska for a long time, and that's really the only LNG export that we've done. But it's fairly small. Yeah, it's not like one of these monster facilities. This is going to be something new.
Yeah, and when there's something new like that, there's always the possibility that it's new technology, things could break, costs could go a lot more than expected. There could be long delays and things like that. So Yeah, there's always the possibility that people are betting that, oh, things are going to go smoothly with Cheniere Energy and things like that. There's no guarantee of that because it's just such an enormous capital investment. I think they're spending many billions of dollars to build a facility out for the LNG export trains. In the remaining part of the interview, what's your opinion then on the pipeline companies for some of these shale plays? If the shale plays drop production, are they going to still have to deliver oil and gas then through the pipeline, or the pipeline companies then going to be entitled to some sort of settlement compensation then? How safe are some of the pipeline companies then?
Yeah, the pipeline companies, it depends on the location, but they're a lot safer. I mean, they've got take-or-pay contracts in many cases where if the producer doesn't utilize the pipeline capacity, they still have to pay for it. Now, if you're a pipeline operator in the Bakken, there is a risk that some of these guys go under. And if you got a take-or-pay contract with somebody that goes under, you're going to have a hard time extracting money out of them. But if you're in the Eagle Ford, I don't think the Eagle Ford is going to be affected a lot. I don't think the Bakken. The Bakken, most of the oil out of there goes out on rail anyway. Warren Buffett's railroad takes most of that oil out of that region. So most of the pipeline companies will be okay. Some of them have been really unfairly punished to the downside, and you'd be looking for some value there too as well. Some of them have gone down 20-30%, and that's probably not warranted.
Now, I definitely agree with that. I think there's a lot of opportunities for income investors, for people who aren't looking for capital gains but are looking for reliable income here to add to positions there to get that. And I think it definitely beats bonds in terms of finding good distribution MLPs. My final question is on the oil sands and deep water. We've just seen these things get creamed. They're higher cost amounts of production, but the world I see going forward, the supply-demand picture, you and I have discussed this before in past interviews, I don't see a world where there's going to be any ability for supply to meet demand, especially with demand increasing out of Asia or Africa, Middle East, Eastern Europe, etc., out of those emerging markets. I don't see any supply being able to grow globally without the oil sands and without deep water. So maybe there will be some production, a few bankruptcies here or there for some higher cost producers who took on too much debt. But I think in the next 2 to 3 years, these companies, some of them have dropped. Seadrill has gotten absolutely crushed. That company was earning $8 per share, I think, last year. They were paying a nice dividend. Do you see these companies coming back in the next couple of years and being important and profitable companies for the oil market?
Yeah, they will come back. The question is how long that will take. I'm not sure how long it'll take for some of those deep water plays to pay off. It just depends on how much more the shale revolution is able to grow and grow. There are shale plays that are onshore that are more expensive than some of the deep water, but a lot of it is not. So it just depends on how quickly the shale starts to peter out. Because as long as we're growing shale oil production at the rates of the past couple of years, deep water is going to have a more difficult time. But you will be correct eventually. It's just a matter of timing. How long does that take?
Yeah, very, very good. And like I said, I think the shale production in the U.S., I think that's going to be the main area of growth driver for shale. Based on all the other things I've read, maybe the shale production in Mexico will be good because it's similar geology and it's just right across the border. But I think the rest of the world, from a shale perspective, it's going to really struggle to have the type of growth that the U.S. has. I mean, the shale in Europe, it's been blocked due to population density. Like there was a large shale formation underneath the city of Paris. That's not going to get done. And, in other countries, it's just there's either political problems or water problems or infrastructure problems, and the costs are just too high. So I think the U.S. is in a unique advantage standpoint. I mean, the U.S. drilled many thousands of holes right into these shale deposits, so they know where the sweet spots are.
Yeah, and you're right. I mean, I don't believe this will be replicated around the world. There may be some specific spots where some of it is replicated, but yeah, the U.S. was in a very unique situation. Other countries are just missing either the geology, the infrastructure, the water, the politics. There's issues in nearly every other country that has major shale resources. Russia might be a place that ultimately can, grow their shale production, but they've still got a lot of conventional oil production there too. So, they probably won't start to exploit their shale for some time.
Yeah, and I don't think Russia has reinvested a lot of their oil profits into new oil production and new technology and things like that. That's one of the things I saw from the Russian oil minister that came out recently. They said they would have problems cutting production because their technology for their oil pipelines and wells and things like that doesn't allow for easy turning off of the oil wells. So they haven't, and a lot of OPEC and other national oil companies and things like that control their oil production, they haven't properly reinvested their profits and their capital. I mean, look at Mexico and what's happened to the Canarell field. They haven't and Venezuela. Venezuela is probably the worst example of this. They don't reinvest prudently their oil profits back into the business to make sure they have new technology and they have great equipment and things like that. Their politicians have been spending the money on political bribes and social programs and things like that. And I think over the long term, that's going to mean, there's going to have to be higher cost supply brought on from elsewhere, that these national oil companies are going to struggle to increase production.
Right.
Okay, well, final thoughts here, Robert. So for our listeners out there, they're scared of the oil price dropping. They're looking for investing opportunity. I think this is the best time to buy oil related investments, especially profitable one. If you do your homework, do good research, or you subscribe to your news. You have a couple energy investing newsletters. What types of industries or sectors in the oil industry do you think are the safest right now?
Well, the safest is going to be your larger integrated companies. I mean, the Exxon Mobils, the Chevrons, those are the safest, but they don't have nearly the upside. So again, it really depends on your risk tolerance. The safest are going to be those companies, the midstream companies, the midstream MLPs. Those are going to be the safest areas.
Yeah, I agree. But I'm buying Lynn Energy though, because 22% distribution, you just never see that, especially when they're hedged. If they weren't hedged, I'd be a little scared. The Seadrill dividend cut, I thought they would cut the dividend a little. I was reading, a lot of other analyst research on Seadrill before I started thinking it was a good buy, and their complete elimination of the dividend surprised me quite a lot. But I guess maybe the board of directors was worried the oil price could go a lot lower, and maybe they're going to do an acquisition here and buy some market share. So it's really interesting what the board of directors of these companies are deciding to do right now. But I think there's a lot of good income opportunity, like you said, in the oil patch from a safer place. Yeah,
and I think Lynn Energy, the expectation of a dividend cut is priced into the price. So you probably will see a distribution cut, but I don't think you'll see the share price get slashed, because I think people are expecting it.
Yeah, there's a possibility of a distribution cut. I don't know for sure because they are hedged. So even if they do cut, I'll still probably buy more. I think it's a good income play. Well, I want to thank you again for your time, Robert. I really appreciate it, and I really enjoy our discussions about the oil and energy markets every couple months. Please tell our listeners where they can find your work and about your newsletters.
Yeah, so I write a couple of newsletters for Investing Daily. I write the Energy Letter. That's a free newsletter that comes out every week that talks about the energy markets. MLP Profits is focused on master limited partnerships. I write one weekly newsletter for that's free, and then I have two paid newsletters. One's the Energy Strategist. My colleague Igor Greenwald and I, we manage a couple of different portfolios for master limited partnerships and for energy companies. And we've got stuff for aggressive investors, conservative investors, growth investors, a little bit for everyone, and that's a bi-weekly newsletter, as is MLP Investing Insider, which we both contribute to. And beyond that, I write regularly on Energy Trends Insider, not necessarily just oil and gas, but energy markets as a whole. And then my book, Power Plays, Energy Options in the Age of Peak Oil, is still out there, and it's a good layman's guide to understanding the energy business.
Yeah, and the energy business is an important business because it's the largest industry in the world. I think it's a couple trillion. It's a multi-trillion-dollar industry, right?
Yeah, and I think that's true. And I think it's always a good idea to have a little bit of portfolio in energy. But people think of me as the energy guy. I've got about 25% of my portfolio in energy, so most of it isn't. But I'm always got a little bit in energy because I think long term energy is as important as food and water for people.
Well, there can't really grow the way modern agriculture is, Robert. You can't really grow that much food without energy. The way we've created our agricultural system, I don't know if there's enough arable land on the planet for everyone to have grass-fed beef and organic strawberries and things like that. So,
Yep.
well, thanks again for your time, Robert, and let's speak again in a couple months. I really appreciate it, and I enjoy these discussions.
Same here. Take care.